Emergencies, they don't send you a warning sign. Whether it's a sudden injury or a car repair or an unexpected medical bill, these surprises, they can drain and derail your finances. But having an emergency fund can save you from stress and debt and sleepless nights. And today, I am showing you, one, how much you should save based on your risk, your dependents, and your job security. Two, how to calculate and save for an emergency and fund that goal. And three, the best place to keep your emergency fund, because not all places are created equally. And at the end, I'll reveal a critical layer to your financial protection that you need to pair with this emergency fund so that you can stay ready, so that you don't have to worry about getting ready. You know how I'm saying goes? Meet Lisa. She is a 34-year-old nurse who loves her job. But last winter, Lisa slipped on ice during her commute. And unfortunately, she broke her leg. So the injury meant that she was 6 weeks off of work. And although she had short-term disability coverage, it only replaced 60% of her income. So between the medical bills and the day-to-day expenses, poor Lisa had to put over $5,000 on her credit card. And she still carries that balance today. Now, if Lisa had saved $10,000, 3 months of her living expenses, she could have avoided debt and focused on recovery instead of stressing about money. Her story reminds us that emergencies can happen to anyone. And I got a question for you. Are you financially prepared? Your emergency fund should be tailored to your unique circumstances. Here's how to determine the ideal amount for you. Now, the Colorado Insight study was a Colorado study found that most people can cover common emergencies with just $2,500. So if you're starting from scratch, this is a great initial target. The next thing you need to think about is job security. If you have a stable, predictable income, then you want to aim for 3 to 6 months of expenses. So for someone like Lisa, whose job involves physical risk, having 6 months is ideal. Number 2, you want to think about your dependents. Are you single and living alone? Well, start with $2,500 and then work your way towards the 3 months. If you have children or dependents, then you definitely want to aim for 6+ months of expenses. And 3, you want to think about your risk factors. Are you self-employed in a high-risk job like healthcare or without a solid health insurance? If so, you want to save on the higher end of the range. Are you renting versus owning? We know that homeowners have unexpected repairs, so you want to save more. So in Lisa's case, her monthly expenses were $3,300. And if she would have aimed for a 3-month target, that's about $10,000. So knowing your goal is your first step. And you want to make sure that you calculate your expenses to reach your goal. So let's say, for example, you wanted to save $10,000 in 12 months. How much would you need to save? All right, so $10,000 divided by 12 is $834 per month, or divided by 52, because there are 52 weeks in a year, that is $193 per week. Now, if this is overwhelming, then just shoot for that Colorado benchmark, $2,500, okay? And you want to make sure that you can fund that as quickly as you can and continue to work towards the rest. Remember, breaking it down to smaller pieces allows for consistent steps, and it makes it more achievable. Small steps equals big progress. Now that you know your goal, here's how you can hit it faster. First, start small. Begin with that $2,500 and work your way towards 3 to 6 months expenses. Number 2, automate your savings. Set up a transfer of $193 per week or $834 per month and get it done. Out of sight, out of mind. Number 3, use windfalls, tax refunds. Although I don't like them, they will help you to boost your emergency savings very fast. And number 4 is to cut unnecessary expenses. Cancel any unused subscriptions or reduce your dining out to free up some free cash so you can have peace of mind. The key is consistency, and every little bit adds up. Now I know you're thinking, but Brittany, where should I keep the money? And before I tell you, I want you to comment below. How much are you going to save in your emergency fund? It's important that we can start to be transparent about our expenses, about our savings, and about our money. Remember, sharing is caring, so let's share tips and ideas. So where you keep your emergency fund definitely matters. Let's explore your best options. Number one is a high yield savings account. And this is where I personally keep my money. And the pros are you earn higher interest than a traditional savings account. Some of the cons is that it's slightly slower access compared to checking, so you might need to use a credit temporarily. Number two is Series I bonds. This protects your money against inflation and grows your money. But a drawback is that it requires 12 months holding period before you can actually access that money. Number three is a money market account. Some of the pros is that it combines the accessibility with some of the interest growth, but a con is that it may have a minimum balance, so you may not be able to access a money market account. All right, you want to know what to avoid? Avoid checking accounts. That's where most people keep their money, but they earn no interest. And avoid investments. Your emergency fund needs to be stable and accessible. We don't want any fluctuations or volatility. So getting one of these accounts will allow yourself just ease and allowing your money to grow as you are saving it, and hopefully can outpace inflation or at least keep up with inflation as you're saving it for emergencies. So here are some actionable steps to start today. So first, calculate your target. Start with $2,500 or aim for 3 to 6 months of your expenses. Two, you gotta open a high yield savings account or a money market account, and many online banks offer competitive rates, so do your shopping. Number three, you're going to automate your savings. Set up weekly or monthly transfers directly into that account, or you can do it from your employer. And four, you gotta track your progress and you're going to celebrate. Like reaching $1,000 or $2,500, make sure you celebrate those small wins. Start today. Your future self and your peace of mind will thank you for sure. Now back to Lisa's story. Lisa's story highlights why an emergency fund is essential. It is your financial safety net. But sometimes even a fully funded emergency fund is not enough. What happens if you're unable to work for an extended period of time due to injury or illness? What will you do? In the next episode, I'll show you why having the right disability insurance policy is the next critical step in protecting your income and your future. You really want to pair these two together. And if you want to get more videos like this, then I want you to subscribe to this channel, give this video a thumbs up. It helps me to reach a greater audience and to impact more lives. Remember, sharing is caring. And if you're a woman in healthcare, then I know you're all about changing and improving lives. And financial wellness is one of the ways that we can make ourselves whole as we care for our patients. Until next time, see you there. Bye-bye.